All right, but it's good to be back after more than a week off, and the market had a pretty down week last week until the very end of the week, which actually was a pretty good bullish sign from a market standpoint to have what would have been a new bearish leg lower halted as quickly as it was and pretty much reversed. And that's how things were looking early this morning until the end of the day. And by the end of the day, we kind of lost that bullish momentum. And I'm going to break down what that means now, like how likely we are to keep that bullish momentum going forward. What would happen tomorrow or Wednesday if we were to fill in the gap from Friday? What would that mean from a technical perspective in terms of, this ending this intermediate decline we've been on that's been going on for multiple months, and what the market leadership is telling us about the expected direction here in the short term to intermediate term. So I'm going to break all that down. We're going to take advantage of a stock that's had its own rally, significant rally, and see how we should trade that as it heads up towards some pretty significant resistance levels. So let's go ahead and get started. Today is Monday, July the 18th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started here, I invite you to subscribe to our YouTube channel, hit that thumbs up icon, like our video down below, comment on the video, join our website at MarketScholars.com. There's a link popping out up there in the top right corner of your screen. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these things over here on the right, including our Market Outlook live video. Come down here, click on this heart. That takes you to a new tab. Like our Market Outlook video there on Twitter. Same thing with this thumbs up icon on Facebook. Come to this tab, hit that like button as well. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. What looked like a good day at the beginning of the day today. We were above the 30-day moving average. We were above the 23% retracement of this intermediate run that we still have been on. This has been one long intermediate decline. The intermediate declines usually don't last a long time. We were going on 1, 2, 3 full expiration cycles, plus about more than half of another one, and going into a fourth one. So that to a fifth one. That's a long time without getting at least this kind of intermediate rally. But that's where we're at right now, and we looked like things were looking pretty positive, but we're still back below. We're back below the red 23% line, just barely though. And then again, if we fill in the gap on Friday, we're going to be back below all these lines and back below the moving average. You notice we're not, we're still kind of in a neutral range where we're up towards the moving average, but we're not breaking down and we're not breaking up either. We're stuck in here in the middle, in between this 2.5% band centered around that 30-day moving average. So we're kind of stuck in neutral. The near-term line rallied. It came off of this near-term low, but the highs and the lows are pretty much equal. This is a near-term high. We had a strong momentum move on Friday, going into expiration date. You had a big momentum jump into extreme levels. A good opportunity to really rally and look like we were going to follow through with that. And then the momentum line just dropped like a rock, almost to extreme levels to the downside. And again, barring a big move to the upside tomorrow, if we fill in that gap from Friday tomorrow, you'll probably get that near-term line back out of bullish territory too. The NASDAQ got hit a little bit harder. It was more bullish, what we saw, because it did get up above the moving average on Thursday. We gapped up and then dropped back below, or just barely. It looks like we finished just barely above the moving average, but back below this 23% line of its intermediate run that it's been on. You can see it's trading right around that moving average. The Russell 2000. You can see what it's doing here. Same thing. It's still below its 23% line. And you remember how the S&P is like barely below the red one, the 23%. The NASDAQ and the Russell are well below those red ones. So that's why, again, my thought is the S&P has still got some room to go because it's, the Russell and NASDAQ are well below that line. And the S&P is barely at it. So, it hasn't dropped as much, and partly because of these blue chip companies, like in the Dow Jones Industrial Average. See, the Dow Jones is actually still above its red line. The red line being the 23% retracement from the 2009 low point. And then that 38% line that you see there as well is the retracement from the COVID low point. So the Dow, remember the Russell and the Nasdaq are well below these two lines. The S&P is barely below them. The Dow is actually pretty decently far above them. So this is what's really holding up the markets right now, is this little rally here, at least the outperformance in these blue chip companies, which, remember, blue chips are the furthest side of the risk appetite scale towards the risk aversion. So the fact that they're holding up makes sense, and they would be the kind of the last shoe to finally break some of these levels that the other areas of the risk appetite spectrum have already broken down. Now let's take a look at the weekly chart. We actually had a pretty decent candle here, but it was only one day. It's a weekly chart, but we only had one day so far in the week. So after getting multiple transition candles, we're still not able to get a reversal. And this week still looking like another transition with a very minimal Heikin-Ashi differential and still a falling PPO that's at pretty low levels for the last 3 years at least. If you go back to the last 20 years, then obviously the 2009 low point. But if you take out that 2009 area, and I guess I have to go out to like 10 years to be able to take that out, it is one of the bigger drops. I mean, it's rivaling the COVID drop in terms of how far the 10-week moving average is below the 40-week moving average. That's what this is measuring. So it kind of gives you an idea of how bearish we are. Obviously, that didn't last very long. It was only a drop of 4 weeks, and then we were rallying again. This has obviously been more than 6 months, going into now a 7th month here on this current market sentiment decline, which is also relatively long for markets for a long-term move. You can see the gap up we had and the move back down. We were above the 30-day moving average. We ended up finishing back below. Let me zoom in a little bit more. We ended up finishing back below both the 8 and the 17-day. Now, just barely. And remember, we're still kind of just barely below the red line, and we're still above the. But if we finish back below this gap, if we fill in that gap from Friday, then we will be easily back below the 8 and the 17-day. And you can see the MACD is flirting with turning down into a bearish divergence mode, where the price is below the 17-day moving average and the MACD is below. So we actually did have that on Thursday, but then Friday saved us, right, by getting back above the 17 and the MACD getting back above here. I mean, that's bullish divergence, but that was a really good close. And if we followed up with that today and gotten up above, say, this 389, like 390 level, and flirted with at least getting above the 50-day, that would have been a very, very good sign. But alas, we didn't, right? We ended up, and you can see the Nasdaq didn't quite get back below these lines, but it was briefly above the 50-day moving average, which would have been really, really positive for it, because you can see above the 50-day moving average, there's a pretty sizable gap in volume here that it can really easily start to fill up towards this 320 area, where you're going to have a pretty significant layer of technical resistance from the value area and all these Fibonacci lines from multiple time frames. They're all sitting right on top of each other. If you take a look at the 3 green arrow charts, you're just not really getting very much movement on the MACD. You notice we're not pink or green. We did briefly have 3 green arrows on the Qs, but then you can see where you got a red arrow there, and this is barely there. So we're kind of getting some green shading, but on the Qs, but we're not getting any green shading anywhere else. The nice thing is we're not getting any pink shading either. Like the MACD is still kind of holding on, avoiding the pink shading there. The same thing here. So the stochastics and the moving average are all giving you red arrows, but the MACD is still holding from breaking back down below its moving average, which is what produces the red arrow here on the histogram chart. I wanted to bring up that whole chart that I show quite a bit. Whoops, here, let me just get to a regular chart. Let's first take a look at this, and we'll take a look at the whole. Here's another oscillator. Again, the positive indicator is above 20, and so that was a good sign from Friday. We still can't get the negative down, though. We got to get that negative down below 20 and the positive up above 25 for us to feel decent about this bearishness being done. And then again, getting the positive above 30 would be the breakout move, right? And you can see even from when you look at the Bollinger Bands with the Hakinyashi, with the Keltner channels, you can see like we got red dots down here, which means the bands, from the lack of movement, the bands are back inside the Keltner. Now, when we're trending, you have the green bar dots. When we're not trending, you have the red dots. And so we're not trending right now. And you also see that on the trend strength indicators. We're not trending. Like there is no trend whatsoever from the trend noise balance or from the trend quality. We're below that blue line, which is the midpoint of this past 26 days. We're below the shaded area here. The red line is still below the price, so they're still bearish, but we're not trending right now to the downside. So that's what you also see too on the Keltner channels, right? So the bands are back inside the channel, so we have red dots. And you notice you're kind of getting some up and down blue bars, but really not, I mean, compared to the size of some of these other blue bars when we were trending, not very big, right? So we are literally not trending anywhere and kind of waiting for a breakout move. If you look at the Bollinger Bands on this chart, the band width has really come down quite significantly. We're still in the middle of the bandwidth, in the lower half of the middle. But we're still in the middle of the bandwidth, but we're not in the upper quartile, which will be trending to the upside. We're not in the lower quartile when we're with the trend to the downside. And the bandwidth, even though it is low compared to where it's been, it's actually still pretty high compared to where it was before that. I wanted to show you the weekly chart here. So we did get a higher high. We got an equal low point, so we didn't start filling in that gap really significantly by the end of the day today, and we've already gone up $1 in the after hours. So there's been pretty good movement to follow up on that last little rally here at the end, and you can see like this is going to come off tomorrow. So the new low point is going to be right there, which is pretty much going to be last week's low point. It's going to be a little bit below that, but by the end of the week, last week's low is going to be the low of the 4-week period. Last week's high is not very far off, and really today's high is not really far off from the high point of the 4-week period. I mean, that's going to be there for still the rest of the week, but you can see, and then when that goes off, if we don't get a new high, we're going to have a new high right there. But the high tag and the low tag, to kind of give you an idea of that graphically, the high tag is the green line and the low tag is the red line, and 0 is the first day of the 4-week period, and the 100 is the current day of the 4-week period. So obviously when you're bullish, your green line, guess what, you get a new 4-week high point. That's what the green line getting to 100 means. When you get a new 4-week low point today, then that's when the red line. But you notice the green line jumped above the red. The red's come all the way down to almost 0. But we haven't, the green line just can't get to 100. I mean, this is like the red line dropping below 70, the green line hitting 0. Those are all really, really good signs. The last sign being the green line jumping to 100. But we can't get a new high point, and we're just kind of down. Like, to have both lines below 30, which is a very good chance that it will, the low point's going to, this is going to give you an idea of how rare this is. So the low point's going to move up to there, so it's still going to be below 30. The high tag is going to be right there. And after this day moves, then the red line is going to really get above. But for the next couple of days, you're going to have both the red and the green lines both below 30. You can see that's not common. We did have that over here. You had both lines eventually get below 30. The green line jumped a little bit above that, but the next breakout was to the downside. And it didn't last very long, but we did get a breakout, and it broke out to the downside. To kind of give you an idea of other periods of time, let me go back 5 years, just to give you a sense of how often both the red and the green line are below. See, when the green line's below 30, the red line's usually quite high. You come over here, and you had a brief period, 1 day, where they were both below 30, right there, 26 and 10, and then you had a breakout to the upside. Over here you can see the green line got down below 30, but the red line was high. The green line got down below 30, but the red line was high. the green line. So you can see how it's pretty uncommon. Here's another instance where they both got below 30, and then we had a breakout, and the breakout in this case was to the upside. So when you get both below 30, you're poised for a breakout. Right? We're poised for a breakout. We're poised for a breakout in the Keltner channels. We're poised for a breakout in the Bollinger Bands, really shrinking in. There's a lot of things that are, the trend strength indicator being down here to 0. You can see it's poised for a breakout. This, you notice it doesn't stay below 0 for very long, right? We're poised for a breakout here. We're poised for a breakout on, like the RSI and the CCI. You can see they've been in. Look, the RSI has been between 40 and 50 for multiple weeks. The CCI is between 100 and negative 100 for multiple weeks. This is poised for a breakout to get either outside of 60 or below 40, and for this one to get either outside minus 100 significantly or above 100 significantly. So you really get us going to the upside. So obviously the question would be which direction. Of course, the trend continues to suggest that direction would be to the downside, so we see something different. You can see the VIX is really low. So the VIX ended expiration at support, essentially at the 90% mark. That's a level of support for volatility. This is when you're trading in this area. 90, all these lines, when you get above them, are all acting as support levels. So now that we're above 90, it's 95 and 90 are both going to act as support. And right now it's sitting at support. And if you look at the VVIX, which is what we've been looking at too a little bit, you can see it's still here below this minus 100. But when you look at, we've talked about this before, when you look at like the historical volatility levels, which would be on this chart, the historical volatility levels have been so high at 30%. Look how far and how fast it's falling. Like, it's falling to levels that sets you up for a jump to the upside. You notice how fast it jumped. It fell back below implied volatility. Just like that, historical volatility, which typically when it's above implied is a bullish sign. Just like that, you're back below that. Again, we're not getting 2-3% rallies. We're probably not going to get any more 3% drops, but we're not getting any 1 or 2% drops either. So we're settling in, and VIX at a support suggests, especially with the volatility of the VIX being so low and their correlations being so low, which is also rare and uncommon, or at least temporarily rare. If everything were to turn up, the expectation would be that volatility will turn up too. Otherwise you're going to be expecting the volatility of the VIX to really break down hard. But if you look at this 86 level, it is pretty low compared to where we're at now, or where we've been. But it's also pretty darn low. Like this low point that we were at is also pretty darn low compared to where we were at in the past too. So this is really low, and as I mentioned to you before, the correlation, the VIX itself is really low at that 90% mark, and then the correlation of the VVIX with the volatility index itself. We'll just go quarterly correlation. Oops. It is. It's, again, you can see the VVIX with the S&P is usually not positively correlated. Come on. There we go. So again, it's starting to increase, but it's been really low, and it's not common for it to be related. It's more common to be very strongly positively correlated. So unless we break down hard at below 90% and break down below 85% hard, which would mean that we break up to the upside significantly, then you would expect that we'll instead probably hold support before we get our bullish move. And that's kind of the way I'm leaning. What do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am? All right, well, let's take a look at what's driving the price action here. You can see over the last 3 months, the commodities have really dropped off, and the commodities have been moving up pretty strongly with the dollar, and now the dollar is the only one holding up, and everything else is still down. But you can see how while commodities have dropped off, equities have kind of held on. Let's just take a look at just today alone. So let's go back to, actually I'm going to take a look at what's happened since I left. So we left on that Thursday. This is since the week that I've been gone here, and how things have performed. Equities did start the week last week down 4.5%. Emerging markets, Qs, IWM, I mean everything down. Obviously, there's been a little bit of a rally on Thursday and Friday, and even into this morning before dropping. The dollar was up, bonds were up. They're still up. They held up pretty well. You can see gold was holding up pretty well. But now let's just take a look at here just today alone, and you can see, okay, commodities started the day, equity, everything risk related started the day strong. It was really U.S. equities that ended up down. The dollar was down sharply. U.S. equities really dropped off, whereas emerging markets and developed markets were down off their highs, but still ended up positive, well above where U.S. equities, which is what you'd expect with a weaker dollar. Commodities strong, gold was strong. Gold outpaced U.S. equities as well as bonds. Again, that's a function of a dollar that came down, and the dollar had been so strong. If you look at it compared to the euro, the dollar had been so strong, but the last couple of days here on Friday and then going into today, the dollar really felt like the euro rallied, and now it's not back above the 17-day. You know, the MACD, we're kind of in convergence mode here. We're not in a declining anymore. We're still bearish because the MACD is still below 0 and we're still below the 17-day, but we don't have the momentum to the downside right now. And remember, the yen is typically associated with safe risk aversion, because of safety trade. You can see it's actually, the dollar is actually still above its 8-day moving average against the yen. So it's still pretty, the yen really hasn't moved very much, and the dollar is still very, very strong against that. So when you look at the dollar itself against the whole basket of currencies, all 6 of them, remember 70% of it's the euro and the yen, but when you look at it compared to all 6 of them, it really went parabolic on Thursday, and now has been pulling back. The MACD is down, the stochastics is down. We are below the 8-day, we're not quite below the 17-day yet. You can see, having to draw this line up to a new high point, we're still well above the 23% retracement, which is, what you look for when looking for new, when trends, to start retracing trends. Here you can look at the market forecast, and we really went bullish over here. We had this kind of bearishness, and it really took off at this point. So if this is our current intermediate run that we're on right now for the dollar, there it is. You can see that again, 28.30 is about the area where you start to look for the retracement to begin. Strong bullish posture, well above the 30-day moving average. The near-term lines in bearish territory, but not oversold levels. So hardly a condition of where we're like, oh, we're breaking down here on the dollar. But keep in mind, we had gotten pretty parabolic. That's on the daily chart. If you look at the weekly version of this, last week, even with the drop on Friday, was about as parabolic as we've seen on a bullish level here in the last little bit. I mean, you have to go back to 2014 to get a level where the ADX was this high. And you can see what happened in late 2014 going into early 2015. And then that strong dollar started this global slowdown for most of that year that ultimately culminated with the correction of 15 to 16. So having a really strong dollar like this is not necessarily bullish for the markets, because again, like you've been probably hearing on TV, a really expensive dollar makes everything more expensive in terms of our export capability. A little bit more less expensive from an import standpoint, but again, it's imagine what our inflation levels would be if the dollar was down. Inflation's been really, really high, but it's been really high with a very strong dollar. Imagine what crude oil prices would be if the dollar was down. Imagine what inflation levels would be if the dollar was down. Like we've had really high crude. We have really high levels of inflation with a really strong dollar. Speaking of crude oil, let's go back to where crude oil is and commodities in general. again, you can see that they had gone parabolic too, relatively speaking, here earlier this year, before pulling back the last few months. Here, let's go to this weekly chart here. Let's go to a weekly chart on this one too. And let's go back to crude oil. So the last few weeks, you can see we had gotten below the 17-week moving average, gotten below the 30-week, long lower shadows that were filling in. And then here, with this move, this current move, with a very, very low histogram, we'll see how far below the MACD, below zero it gets. As of right now, holding the 50-day as it did before. And again, we'll see if that ends up putting pressure. Remember, there's the rising crude and commodities that were negatively correlated with equity prices earlier this year. We'll see if that has an impact, especially with such a strong dollar. I mean, if the dollar were to start to pull back on a long-term basis, I mean, that's gonna prop up commodities. At least keep them high, even if slowing economic growth puts pressure on them as well. We also want to take a look at bonds and see, is that safety trade starting to show signs of reversal? We're off of the lows. We're in convergence mode on a long-term basis, which means we've lost the downward momentum, but we're not going up either. We're not in bullish divergence mode. We're not back above that 17-day. And when you look at the daily chart, look at all of the lines sitting right on top of each other. So, and you got this little bit of inverse head and shoulders. So there's an opportunity for bonds to break out to the upside. There's a wide gap between the 50 and 200-day moving averages. There's a wide gap in volume. Obviously, it can drop down too if we were to break down to these levels. But remember, it's in convergence mode on a long-term basis. So more than likely, it's not going to break down to the downside. So more than likely, any break that we get out of a falling Bollinger bandwidth, which has been falling just like the S&P 500, to the point where its bands are also inside the Keltner channels. The breakout you would assume would be more to the upside. That's where you would expect a breakout to come out of. Let's take a quick look at the sector moves and how they've been performing. So let's go to the sector grid, the 12 grid, and take a look at their market forecasts. So we still have a lot of dark pink shading and red lines all across the board. Some light pink shading and yellow lines here, so not as bearish. That's because they're at high levels, but they're still falling. And then you have light green shading yellow lines, so rising intermediate lines. See, all these intermediate lines are rising, but they're also low. Here, these are all the safe haven trades that were falling intermediate lines. These are all rising, but at low levels and barely above their moving average. So light green shading and yellow lines can typically be bearish patterns. So we need to see some more bullishness out of these sectors, especially with good leadership, to feel really confident about risk appetite taking a leg to the upside. Because as of right now, we're not getting those, and the leadership we're getting is not necessarily the best, right? Materials and energy is not what you would want to expect to lead in a good bullish market. They typically lead at the end of a bullish market and early beginnings of more of a bearish market, even if it's just a correction, correction phase of that bearish. You can see healthcare declining, utilities, all the safe havens are down until about the middle of the day, and then once the middle of the day occurred, then all these other areas dropped, and they kind of held their ground, and so they ended up not being such a big underperformer relative to more of these cyclical areas by the end of the day. All right, now let's take a look at our trade idea of the day. And so we want to take a look at Love. The airlines really had a good week last week, getting well above the moving average, almost up 5% above the moving average. Still, however, they were so bearish previously that the moving average is still declining. And then we got a little bit of a long upper shadow here with that bear tag. That bear tag meaning we got light green shading and a yellow line. Let's take a look at the crossover chart, and you can see that, again, like the S&P, we were getting bullish. The S&P. This is what the S&P's candle looked like earlier today, and this is what the Love's chart is. A relatively bullish candle for one day. Remember, this is only one day so far in this week. Pretty big size. If you look at how big the bullish candle is, it's about as big as it got on some of these other bullish runs that the S&P had gone on, with green arrows no less. If you take a look at like these moving averages and see where we are relative to them, you can see we made our way all the way up to the 50-day moving average with a pretty strong MACD histogram, higher than any of these other bullish levels. The MACD is getting its way up to strong levels, but again, stalling in this case because the gap between the 30 and the 50 is relatively strong, stalling at the 50-day moving average and stalling at some pretty significant volume resistance as well. If you look at some of these other charts, you can look at the Bollinger Bands here. Let's look at the Bollinger Bands and the Keltner channels on both of these. And you can see the bands are inside the Keltner channels. And when you are like this and you're going for green lines, you like to get a breakout outside of both. And obviously we did not do that. And we got a long upper shadow right into resistance on both of those lines. When you look at the Ichimoku cloud, we are 1 day up above, but it's, again, no trend and still well below the cloud, the Ichimoku cloud. Looking at the DMI and the ADX lines, you can see that the negative indicator got to 20. Didn't get below 20. The positive indicator got above 25, but not up above 30. So we're not breaking out here, and instead maybe at levels where we might be kind of peaking at these levels. So what we decided to do here, if we break out, we break out. But if we don't, then we're kind of at this level where we either break or we bounce. And when we're like that, then we decided to do a long vertical spread, buying the at-the-money put for August expiration, selling the 38, going small because of earnings coming up. We have a small position size, half of normal risk, and then going for relatively bigger reward to risk ratio. Again, if we break out to the upside, then we'll probably end up taking a couple $100, and that will end up being about a 4-to-1, about 3.5-to-1 reward to risk ratio, which is really, really good. Small risk for the reward we're getting. Worst case scenario, it's better than 1-to-1, but worst case scenario, like I said, we don't have to wait very long. We don't have to wait to get to worst case scenario before we find out the trade is not working. It's either not going to work now, or we're going to bounce down and get, like I said, get a pretty decent reward at a relatively high probability for a directional setup. Alright, you've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.